Hello and welcome to the April MENA market briefing. So Russian production and exports are still very much the focus for traders, and Western governments are still looking for alternative energy solutions. The big news this month is the decision by the US and the IEA to release strategic reserves on an historic proportion. Today I'm joined by senior oil analyst Mohammed Yasser, and we're going to discuss the fundamental market forces driving price in today's market. Stay with us. Brent futures remain highly volatile due to geopolitical pressures and government interventions, which are creating supply swings of significant magnitudes, amounting to 1 to 3 million barrels per day in some cases. Western governments are grappling with the need to address geopolitical tensions with Russia and at the same time combat high oil prices and rampant inflation, which is creating a cost of living crisis in many parts of the world. Sanctions pressure on Russia by the US, European Union, and some key allies is having a material impact on oil production and oil exports. Market estimates indicate that Russian oil production has fallen by up to 3 million barrels per day, if not more, and Refinitiv data shows a slowdown in Russian exports. This has left a major supply gap in the global oil market, which has sent prices soaring through last month to as high as $140 per barrel. In order to address the shortfall, the US and other allied members of the International Energy Agency are coordinating an historic release of strategic petroleum reserves. The total release amounts to about 240 million barrels, and it will be made available to global markets over the next 6 months. And this is called front month futures, and they were trading as low as $100 last week, bounced back slightly towards 106 now. So we can take a look at Russian output, and official Russian production data shows significant declines through the first quarter of 2022. Official customs data shows production rate fell by about 4.4 million barrels per day between January and February, but bear in mind January was unusually high. Output is expected to fall again in March and April. Reuters survey data, we have it here, finds that output has fallen to around 11 million barrels per day in March and 10.3 million barrels per day in early April. There are reports of production shut-ins across Russia, and that's partially due to Transneft orders, which has essentially seen inventories swell and simply can't take more capacity into the pipeline. Meanwhile, major exporting oil refiners in Russia have also halted or reduced operations simply because they can't find buyers for their product. So Refinitiv ship tracking data shows a decline in total exports of Russian petroleum products in March, and loading schedules do indicate further declines in April. Demand for Russian exports, certainly for crude and refined products, has taken a major hit as many buyers have just backed off due to complications of the trade itself that surround financial sanctions and shipping sanctions, energy sanctions that are starting to creep in now as well. India has been a key buyer of discounted Russian crude oil, while China is receiving barrels under existing government-to-government contracts. However, there are press reports that Chinese majors have actually instructed traders to, or not to, increase purchases to take advantage of those discounts and instead look for alternatives to Russian oil. That's certainly the case with the large Chinese state independent or state refiners. The independents, however, they may be looking to take advantage of those discounts. The consequence of international sanctions on Russian oil supply is estimated to be in the region of around 3 million barrels per day. So essentially, how can the markets now overcome this deficit? Now, sovereign governments and members of the IEA have decided to tap strategic reserves in order to ease tightness in oil supply, and that is offering temporary relief for benchmark prices and pump prices in key markets. The US has been a leader in this respect. President Joe Biden on the 31st of March announced that the US would sell around 180 million barrels of oil from strategic petroleum reserves across 6 months, which accounts for a rate of about 1 million barrels per day. This is the biggest release from the stockpile since it was created in the 1970s, and it includes 60 million barrel per day commitment, which is made through its IEA membership. The latest announcement also comes in addition to action that was also taken back in November and early December when the US released around 50 million barrels per day from the SPR. Bear in mind, though, 32 million barrels of that was in fact a loan to oil companies, which must be paid back and expect to do so in the near future, unless the US government changes the terms of that loan. Turning to the IEA, that organization and members excluding the US agreed to release an additional 60 million barrels per day from reserves. That was at the start of April. And we have the list there on the left-hand side of the slide. This is the second coordinated release from the IEA in about a month, and it's actually the fifth in the agency's history. So the volumetric contribution by each member is generally based, they have a specific methodology, which is inevitably based on domestic consumption. So that's how the calculation has been divided here. And just to give a little bit of detail, New Zealand has announced that 184,000 barrels of crude oil will be released from storage in Spain, and I think 299,000 barrels per day, 299,000 barrels of diesel will be released, and that's held in the United Kingdom. So we've got the SPR release, but is this a temporary solution? And the SPR release in itself is not without risks. The US emergency stockpile is already at its lowest levels since 2002. We can see that from the chart there. And according to EIA data, the SPR currently holds around 564 million barrels, which I believe is equivalent to about 40 days of forward demand for the US. So the commitment of 180 million barrels release over the next 6 months is inevitably going to erode the strategic buffer. That if the supply shocks that we're currently seeing are prolonged, then the buffer and security offered by the SPR will be reduced, and that presents the possibility of further price volatility going forwards. So we discussed the potential impact or the impact on Russia, and the roundabout figure about 3 million barrels per day in terms of supply impacted by sanctions. So we've got the SPR release, and that's going to buy some time. We're going to now look at where the alternative supply might come from in a longer term time frame. So OPEC's the first port of call, and it has indeed resisted calls from the US and Western governments to increase output ahead of scheduled agreements, which is planned to return around 400,000 barrels per day of capacity on a monthly basis towards the end of August, or towards August, the end of July. Now that presents a total of about 1.8 million barrels per day in returning OPEC plus supply capacity over the next few months. After that, OPEC members will be free to raise production without restraint. However, of course, there's a but. The data shows here that some OPEC members are simply unable to raise production. There is a small level of overcompliance from some Middle East and North African nations, but ultimately OPEC is currently producing way below target levels. In March, that came to a deficit of 623,000 barrels per day. Now, some members are technically or infrastructurally unable to increase their output, and that's due to underinvestment, and we've discussed it in past episodes with respect to West African producers. However, Saudi, UAE, and Iraq, they all do have spare capacity, which may be tapped if they choose to raise exports. Now they would have to, in fact, raise production beyond historical levels in order to plug the perceived supply deficit. So OPEC has recently challenged, in addition to that, the OPEC has in fact challenged recent IEA demand estimates and is of the opinion that supply gap is not actually as severe as some Western nations suggest. And that's part of the thesis and their argument not to increase production ahead of schedule. The point here is that there is some resistance from key OPEC governments to pump more oil. So even with the price incentive to raise production, free of OPEC plus restraints come July or August time, we have to question whether or not there's a political will to do so. The other factor that we need to consider is Iranian supply. And that's again been covered significantly in recent episodes. I encourage you to look back at those. And the conclusion that we've drawn, having looked at historical data, is that Iran could return around 1 million barrels per day in output and exports in a relatively quick time frame if sanctions were allow them to do so. Now, if the US and Iran can restore the nuclear agreement and waive sanctions, which have prevented exports since 2018, then global oil markets could see a very important fresh injection of oil supply. Nuclear talks, as we discussed recently, are in an advanced stage, and they have been for some time now, and appear to have stalled recently due to some strong positioning in part from Tehran. And meanwhile, the developments in Eastern Europe with Russia have also complicated the matters further. European governments are certainly strong advocates for a restoration of the JCPOA and a removal of US sanctions. And the Biden administration and equally is in favor of restoring a nuclear agreement. So this bodes well for a solution, but there still seem to be some stumbling blocks. But an end to sanctions and restoration agreement within a 6-month time frame is by no means an unlikely scenario. So domestic US production is still far below the 13.1 million barrel per day peak, which was recorded back in 2020, prior to the pandemic. Now, federal authorities estimate that production will increase from an average of 11.2 million barrels per day in 2021 to 12 million barrels per day on average this year, and increasing to 13 million barrels per day in 2023. Now, the SPR release has just brought the government essentially 6 months to accelerate that process. Just based on historical numbers, we could foreseeably the US could foreseeably bring back 1.4 million barrels per day in additional crude supply if previous levels can be restored. Now, US oil companies are benefiting from high oil prices and have shown, however, production restraint in a post-COVID era as shareholders have pressured management to essentially pay down debt and also increase dividends. So rather than expansion of supply, it's been a case of increasing revenues and lowering outgoings. What would it take for that to change? Well, fresh government pressure and incentives could tilt the needle in the favor of increased supply and cause or prompt an acceleration of production. Now, it'd be key to watch the US rig count over the next 6 months. We see it's been a steady rise since the lows of the pandemic a year or so ago. But in order to reach 13 million barrels per day in terms of historic levels or production levels, we need to see a significant acceleration in the rig count from what we're seeing presently. In addition to that, there are reports of crew shortages following the aggressive layoffs we saw in the recent past. So there's a further stumbling block to achieving a short-term and significant increase in US production, but one which could very importantly plug the gap. So just to sort of tie off some of the points we've raised here, at least on the crude side of things, on the supply side of things, we've got Russian production, which is down by 3 to 4 million barrels per day as a result of sanctions. That could fall further if sanctions were to become more aggressive, and if Europe were to start or impose an oil embargo or energy embargo on Russia. But so far, there's been restraint, and they haven't chosen to go down that road just yet. So working on the numbers of around 3 to 4 million barrels per day, where do we plug the gap? And we'll discuss those. OPEC technically could return 1.8 million barrels per day in production over the next 4 months or so, with a caveat that it would rely on Saudi, Iraq, and the UAE to pump more than they have done in the past. We then have the potential for Iran to bring back 1 million barrels per day. That could happen relatively quickly if NIOC can deliver on what it says, and if sanctions are lifted, negotiations make a breakthrough. And then finally, we've got the US, potentially 1.4 million barrels per day between present production and historic highs. So all in all, that's 4.2 million barrels per day in production capacity, at least in historic terms. That could be brought back online in a relatively short period to plug the gap in the drop in Russian output. So I think there's a chance with that in mind, so that's a pretty sort of best case scenario there. That could serve to anchor price at the back of the forward curve when you look into the latter parts of 2022. Meanwhile, at the front of the curve, the SPR release, yes, it's helped to ease short-term supply concerns, but perhaps only on a partial level. So SPR to release 240 million barrels per day adds essentially 1.3 million barrels per day over a 6-month period, which again, as we say, it bides time for necessary developments in the Middle East and in the US. But there's some big questions there, and I think there's plenty of volatility ahead for the crude market, certainly, and no doubt the product markets. I'm going to hand over to my colleague, Mohammed Yasser now. He's going to be able to give us a lowdown and some highlights from the clean products, refined products market. So Yasser, do you want to take it over from here?
Sure, Tim. Thanks for those insights on the market. As Tim gave us a brief on the crude oil exports, I'll try to give more information on the clean products exports from Russia. Later on, touch base on the inventory levels for middle and light distillates, and then ended off with the clean products pricing. So as you see in this slide here, Russia is a big exporter of gas oil and naphtha, both to Asia and Europe. Both gas oil and naphtha exports from Russia have dropped around 10% month on month in March, but the exports have not recorded a steep drop as it was anticipated earlier. Gas oil exports from Russia were down by about 350,000 metric tons in the month of March and was assessed at about 3.8 million metric tons. However, Russian gas oil exports to its top 8 destinations were up in the month of March, which you can see on the left chart on the bottom. As exports to Germany, Poland, Turkey, and Netherlands recorded an increase month on month. On an average, Russia has exported about 3.5 million metric tons of gas oil every month in the past 15 months. And on the chart on the right-hand bottom side, you see naphtha exports in the same lines from Russia were down about 190,000 metric tons in the month of March and was assessed at 1.4 million metric tons. Russia has exported about 1.5 million metric tons of naphtha on an average every month in the past 15 months. However, Russia the exports for naphtha from Russia to its top 8 destinations were slightly up, as exports to Belgium were higher in the month of March. Although South Korea, the biggest market for Russian naphtha, recorded a drop in March. Russia exports about 40% of naphtha to Asia, and South Korea is its biggest importer. South Korea used to import about 500,000 metric tons in an average, and which is about 33% of the total Russian naphtha exports every month. South Korean naphtha importers such as YNCC, among other petrochemical producers, have already started to avoid buying Russian naphtha, as companies are unwilling to take risk due to the mounting sanctions on Russia. At the same time, European countries are also under discussion to look at alternatives to that of Russian oil imports. As we already know, United Kingdom has announced that it will stop all oil and oil products being imported from Russia by the end of the year. There are other European countries as well who are planning to do the same, and are scheduled to lower or completely stop imports from Russia, at least by the end of the year or early next year. Moving on to the next slide, we see the middle distillates inventory levels. So on the next slide, Tim, if you could move to the next slide, please. So considering the demand for most of the oil products have been increasing of late, after more or less all COVID restrictions are being removed by most of the countries globally. At such times, if exports from Russia is also impacted due to the sanctions and other measures which are put in place, it will surely impact the global supply of oil products in the world. And hence the SPR release from multiple countries will help in the near future. Now let's look at the middle distillates inventory to know why that is important. Middle distillates inventory globally have been on the lower side thanks to robust gas oil demand and slow increase in the jet demand as well. As more and more countries remove restrictions related to COVID, demand for gas oil and jet have increased considerably this year. Around the world are increasingly traveling more, which has supported jet demand in all regions. Middle distillates inventory in Singapore and ARA storage are at the lowest in over a year. To put that into context, average weekly storage figures in Singapore for middle distillates in the current year is assessed at only about 7.7 million barrels compared to 11.84 million barrels in 2021. And in 2020, the middle distillate storage in Singapore averaged about 13.84 million barrels, which is significantly higher than what it is for this year. US gas oil inventory has been falling from January 2021, which you can see on the chart on the right, and has dropped to a 5-year low of 112.14 million barrels mid of March. The inventories slightly improved the last week, but are well below the yearly average. Weekly inventory numbers in 2021 average around 119.54 million barrels in US. Compare that to 2021, which was which stood at 137.74 million barrels. So 2020 again, the average has been significantly lower at just about 119.54. Compare that to the 2020 average, which was 155.92 million barrels. Now, moving on to the next slide, we have a look at the light distillates inventory. Light distillate inventory picked up in the end of last year after dropping during the summer season, which is a normal seasonal phenomena where gasoline demand is at its highest. Light distillate inventory of late has been declining in all major storage hubs, with summer driving season just around the corner for this year. When gasoline consumption is at its maximum, inventory levels are expected to remain low going forward. Light distillates inventory at Singapore storage is currently assessed at just about 12.64 million barrels, which is the lowest in the last 14 weeks. Average weekly storage figures for light distillates in Singapore in 2022 is currently assessed at 13.97 million barrels compared to that of 2021, which stood at 13.3 million barrels. However, in 2020, the average Singapore stocks were assessed at about 19.24 million barrels weekly. Likewise, gasoline inventory in the US has dropped in the past 7 weeks. When you look at the last 8 weeks, it has fallen for 7 weeks, and the demand for gasoline has improved post-COVID lockdowns and curfews. And due to some refinery maintenance in the US, the inventory has been on the lower side as well. Moving on to the pricing slide. So the next slide, we look at the middle distillates pricing. So the middle distillates inventory globally. So the impact of that can be clearly seen on the cracks for middle distillates. Gas oil cracks, after reaching an all-time high of about $44 per barrel, dropped off, but still remains strong and is currently trading around $31 per barrel as demand for gas oil remains robust in Asia. Gas oil demand picked up as more and more countries came out of the COVID restrictions, while supply remained low as China decreased its H1 quota for this year, and hence the clean product exports were quite low for the year. And with mounting sanctions on the Russia, this has created quite a bit of vacuum, or is expected to create a vacuum in supply if the restrictions, or if more sanctions on Russia are levied sooner. Jet cracks as well dropped after reaching an all-time high of about $36 per barrel in early March. The crack is, however, trading at about $24 per barrel as jet picks up across the globe. The demand has been improving quite a bit as more and more people look to fly across, and as and when the restrictions were reduced across globally, we did see more and more flights taking off. Now, as per the latest IATA numbers, the Middle Eastern carriers performed well with the traffic in the region surging about 215.3% in February, and compared to that of last year, we saw 145% increase in January as well. Industry-wide revenue for passenger per kilometer, which is also known as RPK, increased by 115% year-on-year in February 2022. They were at 84.5% in February 2019, better than in January, but slightly below December 2021. Seasonally adjusted RPKs posted a strong increase and is expected to be quite strong in the month of March as well. The conflicts in Ukraine only had a limited impact on air travel as demand in February were not impacted as such. However, the impact in China, where Omicron cases have been increasing, there was a slight drop in the bookings for flights. But overall, the flight market is looking quite good. The steep backwardation in gas oil and jet forward crack has been another reason why storage economics are not at play currently, as refiners look to sell these products as early as possible to make the most profit. Moving on to the next slide, the light distillate pricings. The naphtha cracks of late have been under stress due to high input cost at the time of low underlying petrochemical margins. Also, as winter comes to an end, competitive feedstock like LPG has fallen. The prices are lower to that of naphtha, which has impacted the naphtha demand. Naphtha cracks reached an all-time high of $7.36 per barrel in early March, but have come off from those high and currently trading at about $0.6 per barrel. Refinery run rates have been cut to anywhere around 70 to 90% in multiple refineries in Asia, thereby impacting demand. However, demand in naphtha from the gasoline blending pool seems to have provided some support as travel restrictions connected to COVID is removed almost completely in most of the countries. So gasoline cracks are expected to remain strong in the coming weeks as demand is expected to pick up in the summer driving season, which is when usually the peak driving activity takes place, which usually boosts gasoline demand. And also the month-long Ramadan festivities have also led to an increase in gasoline consumption in Indonesia, Malaysia, and also in Middle East. Cracks, as a result, are trading at around $14.6 per barrel, and this is expected to further strengthen, if not remain strong, as demand is expected to increase come summer. China lockdown, however, seem to bring about a bearish sentiment in the market as the COVID cases has brought about an increase in the lockdown measures which are set in place in a lot of Chinese cities. The major cities like Shanghai are under lockdown. This will have a bearish impact on the pricing for clean products. For example, we were expecting about no gasoline exports actually in the month of April from China, but due to the lockdown, we now expect about 500,000 metric tons of gasoline exports. So demand likewise for gas oil and naphtha will also be impacted due to the strict curfew measures in place, thereby adding the element of bearishness in the market. But otherwise, the market has been quite bullish for at least gas oil, jet, and gasoline. And the main topic here was speaking about the SPR release. So that would bring about a short-term relief in terms of supply to an extent, but in the longer term, we'll have to wait and see how that works out. Yeah, that's it from me, Tim. Over to you. Thank you.
Superb. Thanks so much, Yasser. Excellent. Well, okay, that's it from us this month, and we found the information useful. We'll keep you updated. We're producing regular reports on a weekly basis, so make sure you sign up for those across the product spectrum. If you want to contact us directly, our information is available. So until next month, take care. Thanks for joining us. Thank you, Yasser.